Today is Friday, March 28th, and earlier this morning we got an update to Core PCE. This is the Federal Reserve's preferred gauge for our nation's inflation. And you can see on the screen that once again, it ticked back higher. Now, it's important to note that the data that was released this morning is from before the Trump tariffs went into effect. So if those tariffs remain in place, there is justifiable concern that inflation is going to continue to move higher. Now in the top pane on this chart, I've got the S&P 500. In the bottom pane, I've got the GDP rate of change. And some would refer to our economy as a Goldilocks economy if the economy can grow at a rate between these two red lines. And if we go above and below those lines, that's when we create a lot of volatility in the economy, and a lot of volatility in the economy leads to a lot of volatility in the stock market. You can barely see it because I've got this scaled, but this is the 1960s and early 70s where we saw 4 bear markets in about 15 years. Notice that rate of change. Well, we already know that the Atlanta Federal Reserve's GDP Now tool is already forecasting a negative 1.8% for the first quarter of this year. That would push our economy below the bottom barrier of that Goldilocks measurement. Now on the screen, I've got the average performance for the S&P 500 for the first year of a presidential term since approximately 1952. You can see at this point of the year, on average, the S&P 500 is positive 0.31%. Where are we at year to date? Well, if we use the ticker symbol SPY to proxy for the S&P 500, that's negative about 4.7%. If we use the triple Q's ETF to give us a proxy of the NASDAQ, that's negative almost 8%. And the Russell 3000, which we like to use as a broader measure of the United States stock market, that's negative 5%. So what conclusions can we draw from this? Well, the reality is not much. The only thing that we can say for certain is that so far, this is a below average year. We can't take that and extrapolate that and say that this is going to be a negative year. We can't draw that firm conclusion. Likewise, we would be foolish to take a look at the historical evidence and say the first year of a presidential term is always up, because that's not a good conclusion either. As portfolio managers for our clients, we believe that our first job is to measure risk. And we define risk as the risk of losing money. So one of the tools that we use is our VSI indicator. You can watch a video on our channel about that if you have any questions. But as of March 1st, the indicator was already on a warning light, and it flipped to a full red just a handful of days later. As a result, our clients are already positioned in a defensive posture. When the data suggests that we should go on offense, we will. If you have any questions, by all means, let us know.